Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in, take a look, and see what people are sharing. If you want to follow me at _Finance, and if you want to join our community, finding-value.com, I go through all this stuff, looking for potential investment opportunities and sharing my opinions with everyone in the community about those opportunities. And we do go through quite a bit in those question and answer session calls. They are recorded. You can see previous ones uploaded to the website. We go through conference calls sometimes. Sometimes we go through macro charts, individual companies. We go through all sorts of stuff during these Q&A sessions. And the people do, they do have recommended topics to cover, and that's what I cover. So Christine Guerrero says, "Drill baby drill was actually drop baby drop. America's oil basket is shedding rigs like there's something wrong with the commodity prices. Thoughts? Look at the rig count drop here. This is Permian rig count. And just recently we've been dropping. We've been dropping way before the most recent pullback in oil prices. Oil prices are too low. We're going to see oil supply decline, and the market's going to self-correct. It will self-correct where oil goes to $90, $100 a barrel, where it needs to be at some point for the growth of oil production to match the demand of oil. And then eventually, and this is my opinion, I think $100 oil is not going to be enough. And I think 150 won't be enough. We're going to go way up there, and we're going to hit geological constraints within 0 to 3 years, and that's when we're going to get tested. So this rig count, I think, will reverse. This is probably going to bottom out in 2025 here at some point soon. GDXJ, Junior Gold Miners ETF, is breaking out from a 12-year base. The bigger the base, the higher in space. It's time to position in the TXXV Juniors market. I would say that this is even late for me. I know a lot of people, the technical guys, they like when lines get broken. What I do is I try to buy things that are down quite a bit. So I'd have no problem buying it down here at $30, be sitting on a 100% increase and getting the breakout right now. The reason I would say that this is a lower risk entry point than a lot of the chart traders is because you already inverted the yield curve. And the inverted yield curve, when it uninverts or just goes sideways, gold generally goes up. So that was the lowest risk area to be purchasing if you knew the market conditions where gold and silver work under, and then the mining companies. The mining companies should come a little bit later. We saw bottoming patterns in a lot of different companies, not just GDXJ, but there was a whole bunch that were bottoming in here. Some of those companies are up multiple hundreds of percents off their bottoms already. Can you imagine being multiple hundreds of percents already up and this is about to break? It's probably going to turn into 10, 20, 30 times your money if you're patient enough to hold on. So I think we've got a lot of really good opportunities. There's some that are still down, very much so right now, that are incredible purchases. So there's a variety and a mixture of companies if you're looking for potential investments over the past few years that you could have accumulated. There's still some that are down right now that you could accumulate right now that are juniors that have just upside potential. Yin yang is what I'll call it. When this thing does break, I think they're all going to start going. So get ready. This is probably one of the most undervalued sectors in the market with the greatest amount of potential. It's an incredible opportunity for anyone who's looking. And again, I'm not trying to throw this out there, but if you guys want to ask what companies I'd look at during the Q&A for gold and silver, go ahead and ask, and I'll show you companies that are still incredibly good entry points. Anyone who's part of the website, they know the companies that are good. You guys, you follow it like hawks, like I do. And I am surprised at how fast a lot of the people have progressed into how good of an investor that they have become. Very, very confidence inspiring. You guys are pinpointing your buys. You're looking at patterns. You have the confidence to hold through market volatility. I mean, that is incredible. I'm very proud of a lot of people that are a part of the website. Very proud. The grain train is about to leave the station here. This is wheat. Wheat coming on up. We've got a downtrend that's about to break. All of the commodities are going to go at the same time. Why? Because it's the same driver. That same driver is a weaker dollar. So these are all priced in dollars, and they're all, with the dollar falling, they're all getting stronger. So that's your commodity bull market. Oh my God. So we've got a downtrend in Bitcoin that is following global M2 money supply. But look what just happened here with global money supply here on the right hand. This is a wave of inflation that's going to be coming and slapping everyone in their face. It's going to be big for commodities and it's going to hurt the dollar. This hasn't been priced in yet. Why? Because money, when it gets printed, the only thing that prices this money supply in is gold. Gold prices it in real time. Everything else lags behind it. I don't know if Bitcoin's going to follow it. It looks like they're showing this as a strong correlation between global M2 and Bitcoin. Maybe it does follow it. I don't know. It's tough to say. We haven't seen Bitcoin in a market condition that is not good for it. Um, it was created in 2009. 2009 to where we are today was the bull market for Nasdaq, and that's when Bitcoin was created. Now we're going to be coming into unfavorable conditions, and Nasdaq may not go up under those conditions. It might go up though if enough money is printed and the global M2 money supply goes ballistic. There is a possibility that everything goes up. It just goes up slower than other things. Here's Kevin Bambro. He says, understanding how the past cycle played out is key. He's talking about uranium here. It's the long-term contracting cycle that will drive the market higher, and that's still barely getting started. Last cycle, investing with people and companies like Bill is a CEO of Encore Energy, and Energy Metals had us ride winners from tens of millions to for exits in the billions. I expect no less this cycle. In fact, I expect more. The long-term macro picture on nuclear power and the need for uranium has never been better compared to previous bull markets. So I agree. We're in a bull market, guys. And I hear, maybe not here, I see a lot of on Twitter where people are just dogging on uranium and they're dogging on all these different sectors. Oh, it's not going up. They have no clue what they are doing. What you need to do is you need to figure out what a driver of a long-term bull market is. You study the long-term nature, and then you take advantage of all the people that are negative in the short term and accumulate. Accumulate. You buy the dips and hold on in a bull market. So it's highly important to understand how to track a bull market. And he's saying, look, it's the long-term contracting cycle that's going to drive the market higher. So are you following the long-term contracting cycle? And is it going down or is it going up? I'm willing to bet that most uranium people or uranium investors probably don't even know what's going on with that contracting cycle. They probably have no idea. You can log in and follow it using Cameco. So that's the largest company. You can listen to their earnings conference calls on their website and just listen. Listen and see what they have to say. And most people, they're so lazy that they won't even do the minimal work of just like listening to one conference call a quarter just to see what they have to say and what the insiders have to say. Hard Asset says Tavi, and it says Jamie Dimon expects the Treasury market to seize up, followed by Fed intervention. Dimon predicts Treasury market kerfuffle where Fed steps in, and Here's a summary of it. JP Morgan, JB Diamond expects a kerfuffle in the US Treasury market that will prompt a Federal Reserve intervention. Diamond attributes the expected turmoil to all the rules and regulations and believes the Fed will step in only when they start to panic a little bit. Diamond advocates for bank rule changes, including exempting treasuries from the supplementary leverage ratio to avoid a repeat of the 2020 treasury market seizure and to allow banks to become more active intermediaries in the markets. So that's what he's saying. Now, here's the thing. If they do step in and help this, that is money printing. Now, they may already be doing this. That's what this is. This big move higher, that could be what they're doing already. Maybe, maybe. This is what we needed to see. Total implosion in the financial demand for oil, with net speculative length falling by the most in a single week since at least 2011. Worse than COVID. Now approaching levels that historically have resulted in an oil price bottom. So this is your net oil length and how low we've dipped into. And you can see these are bottoms in oil every single time. Coming on down, CRB index versus the S&P 500 put in a double bottom. And we just recently broke out of this tip here to the upside. So this looks fantastic. Everything looks fantastic. And you can look at all these different ratio charts over time. This was your last commodity bull market. If you could have sold your bottom and your top, maybe you sold a little bit after. It'd be hard to catch that because didn't stay up there very long. And this is your bottom here in 2020, and we are in a bull market. It's probably a double bottom is what I'm seeing. Dow Gold equals 1. This is GDX divided by Dow Jones Industrial Ratio. Whoa. So GDX is starting to break out and really start to put in a potential new high. That's important. So what we want to look for is we want to see a new high get generated. So when you look down, you get lower highs, and then eventually you get a higher high, and then now we broke out and did another higher high. So now we're in an uptrend, a new uptrend after breaking this downtrend for GDX versus Dow Jones Industrial Average. Looking good. Rory says a crude speculative washout. The net managed money position, hedge fund speculators in Brent crude cratered last week following Trump's tariff announcement and OPEC's surprise output hike acceleration. It was the largest weekly decline in net position on record. Wow. Wow, wow, wow. And that's a wrap, folks. Buy everything, says Arthur Hayes. Just in, top Fed official says the Federal Reserve is ready to help stabilize the market if needed. Money, money printed. Money, 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 money. Money. Here we go. Trump got his weaker dollar. Look at the dollar come down. Weak, 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 weak. Straight ripping lower. They're coming. So how to buy gold. Look at this. For searches, interest over time rocketing higher on how to buy gold. People are searching that. Patrick Karam says, by this measure, silver is falling behind now, as gold versus the consumer price index is above its historical breakout line. Silver has better chances of catching up after stock markets bottom from an important bear market. So, a couple of things that I want you to walk away from here. So this is gold adjusted for inflation. It's breaking out. This is very similar to 1970 that had a huge breakout. And then another one from 2000 up to 2011. This one is a breakout above everything. This is also a cup and handle that's broken to the upside. Your projected move is the size of the cup projected on top of it. So let's go in here and just do a little bit of so XAG or XAU USD divided by consumer price index, which will be, let's do this, CPI. Well, come on, consumer, it's USCPI. There it is. All right, so this is the chart, and I've worked with this as well. We're going to put it on a line chart. So it's a big cup and handle. You can see the big cup and then the handle. Got a little, like we got like a dream within a dream here. We got a cup and then the handle and then another cup and another handle through there. So this is a cup and handle, and then this is a cup and handle. So that is broken out to the upside. You can see we are clear above these highs here. Your projected move, if we were to squeeze this up a little bit, move it over, your projected move is this gigantic move higher. It's got a long ways to go here, guys. What does this mean? Why is it so important? What this means is that gold's been outperforming the consumer price index. This will be the margins of the gold and silver, or well, gold mining companies. Their margins are getting bigger and fatter. So this is an opportunity to invest in gold mining companies. And hopefully you guys are still in them that are part of the website, that when we purchase them back in here, that we've got a long runway ahead of us. So be patient, guys. Now, another one to look at. I'm going to change this to XAG, which is silver. XAG USD. Now, gold's already broken out, and what we're looking at here is silver. What's important here? We can come on down. We can also hit the tops here. So we might be breaking out already. Some people say, well, you can't cut this off. Well, 2 points don't make a trend line either. So if you make this is a couple contact points coming through here. One could say that we are starting to make some good headway against silver versus the consumer price index. You can also look at this and take a different time frame. You could back it out, put it on, say, a 12-month candlestick. Let's zoom this thing out there. This is a 12-month closing. No, I went back to month. Hold on. 12 months. So here's the 12-month, and you can get some of these wicks out of the bottom there. So this is a 12-month closing price versus CPI. You can see that we've broken out here recently with that if we close the year strong. Irrespective, it doesn't matter. When silver outperforms the consumer price index, that's when the silver mining companies are going to go up, because that's when their margins expand. Gold is our leader. So if you look at gold, that's obviously broken out. It's ripping like we've never seen before almost. And here is the breakout there, moving on up. So if gold has broken out and silver will eventually follow, I think that silver is probably one of the best generational opportunities that I've ever seen. Oil is too. I think oil is going to be great. I think coal, I think all of these. And as gold rips higher, the rest are going to follow gold. So we're in that bull market, guys. We're in it. When silver breaks out here and starts to break higher against consumer price index, I mean, I don't know how to put it. Like, the upside potential here is so stinking ridiculous that you have to position, you get in there, and then you just sit. You just frickin' sit. And I don't know how important that is for everyone to just listen to. It's just sit. When you're in a bull market, you sit. These are the biggest patterns I've ever seen. Like, this is it. So again, if you want to join the website, I'm not trying to plug that in there. You can see the companies I like, but this is so good. So good. I'm so happy for anybody who's positioning can hold through this. Most still haven't grasped the magnitude of what's unfolding. The US has just shattered trust in the base layer of the global financial system, which is dollars and United States treasuries. The only asset left that can carry the weight and trust of global capital is gold, but not at these prices. And that's exactly true. That's why we have these charts that are gigantic and they're generational opportunities. They're everything that we are talking about in all of these talks are all interconnected. Everything. The dollar weakness, the flight to gold, the flight to eventual silver, the 45-year cup and handle patterns that are breaking to the upside, the outperformance of these assets versus the consumer price index versus Dow Jones versus SPX versus whatever the heck you want to put against it. These are all generational opportunities. And it's all interconnected. Everything here and all this information is all interconnected and it all says the same thing. What does it say? Gold is going to rip, silver is going to rip, eventually crude oil will rip. It deals with a problem of dollars. It's the shattered trust in the layer of the global financial system. That's the problem. Rates go higher, markets implode. Rates go lower, market explodes. In my opinion, we have seen the trough in the energy sector. We will enter into phase one. I'm not really sure what phase one means, but probably that means much higher prices. Failed breakdowns produce the strongest moves higher. So I was talking a lot about false breakdowns. He says it's go time for commodity bulls, and I agree with that. Failed breakdowns are ones where the market gets fear in the market, it forces it lower to one side, where you're at the tip of a decision. So we can look at crude oil because that's one that has a false breakdown, in my opinion. And what that looks like is when you go here, we go to the daily candlesticks. So what that looks like is you create a pattern here. Let me get some of this out of the way there. So you get this this pattern here where you get a big move up. Your consolidation is this three hump consolidation, and then you can break to the downside. This is called a false breakdown. What happens in this false breakdown is that people get super bearish. Everyone on Twitter is going to tell you that crude oil is not good. You should be riding gold. They're going to tell you that crude oil is not the spot to be. Everyone's bearish in crude oil. Why are you going into crude oil? And they fail to see the bigger picture view. They fail to see that the dollar is driving this and that crude oil, which is the most inflation sensitive asset and has very good, very good leverage to the upside when the dollar drops. So this is called a false breakdown. They call it an FBD. People get short here. They get scared. They get short. They think the markets are going to crash. It gets everybody caught on one side. Now, the break-even point is probably somewhere like up here. That's your break-even point for some of the companies. You'll start to see things slow down. As we've been below 85 here, we've been seeing a slowdown in offshore in certain areas. That is rigs being pulled or delayed depending on what you're looking at. We've even seen some scrapped rigs. This is going to be potentially a false breakdown. We don't know for sure, but I would say so because we're underneath the cost curves, and that this is going to rip and squeeze all the shorts in it. And that's where everybody got it wrong, was the false breakdown. Now they're going to say, oh, it broke the pattern to the downside. No, this is going to go up no matter what, in my opinion, with time. With time. You can't stay below the cost curve for forever. So we had another one that was very similar here. This is a false breakdown. Just to show you, this was 9/11. And all the fear that was driven by 9/11. The 9/11 came, it drove oil lower and created that false breakdown out of this pattern here. And then look what ensued after. We went from the low of $20 all the way up to 75. And then eventually we went all the way up to 150. So I think that where we are today is right here where 9/11 was. That's what the tariff move basically created, and then we could do something like that, just like back here. That's what I think is occurring in the markets. It's false breakdown. 2025 gold miners are up 40%. Gold's up 21. Silver miners up 20. Platinum's up 3. We have oil down 13%. Coal's down 34. So here is my opinion on this. You know where I think the most opportunities are? I'll show you on this one little chart here. I think silver miners are a huge opportunity, probably the biggest on this chart, one of the biggest. I think coal's the biggest, and I think oil is. Why? And uranium. Uranium's down here too. I think coal, uranium, oil, and silver. Silver and silver miners. The charts say that silver's ready to go, gold's been ripping. These guys lag behind it, and everybody hates it right now. Those are your biggest opportunities. And these are generally, coal is the largest leveraged area. So I'm looking at companies in those sectors this weekend, and I'll share what I think are some good ones. Dow Gold equals 1. I started this account in 2021 based on this chart, not the consequence of dropping below the 29 peak. This is the long-term capital rotation has been warning you about. Ascending trend lines aren't perfect, but they're interesting clones here. And here we are breaking lower in that ratio of gold outperforming Dow Jones Industrial Average. Each one of these declines was a commodity bull market, and we're just starting this big commodity bull market. Here was the bottom. So this fail, where he says fail, that was actually a bottoming of commodities. It bottomed in 2020. You could say it bottomed in 2016 as well. That's your double bottom. So it's a double bottom. It's an inverse double bottom. Draw a line across here, lead in pattern, double bottom, and then we're breaking out of that trend line here, the horizontal line. We're breaking out of that, and we're starting the bull market right at the beginning of it. Eric Nuttall says U.S. oil rig count down by 9 week over week equals the biggest weekly drop in about 2 years. U.S. shale is in the death zone at $60. More rig and job losses to come. Too low. There's another one, S&P to 500 to gold ratio, that's breaking down. All of my charts suggest we're at the beginning of a parabolic move in commodity juniors. Stronger than 2016, 2020, more like a 2000s commodity run. I'll cover the signals in the weekend Substack report, and that is true. I believe in that. Why I'm already positioned in all of it. David Burrow says both the US dollar and the US long treasury bond are being sold aggressively. The biggest, most liquid markets should not move like this. Investors don't like volatility in safe haven assets. There is a risk that something is coming unglued. This needs to stabilize or risk of an accident increases. The rise in gold is part of this equation. So this is long-term US Treasury bonds. You can see we've broken to the downside with big volume. Looking pretty ugly here. We also have the dollar index breaking lower, and you can see we've got a trend line at about 100, and that's starting to break below that as well. Not good. And gold is going in the opposite direction. This thing is like a rocket ship that's launched, and it's moving higher. Now, a lot of people, this is the relative strength indicator right here. You can see that we are coming on up on some of these MACD. I think this is probably relative strength here. And then they're going to say, well, it's too high. It's like, no, guys, we could ride up here for a while. This could go a long ways up, depending on the conditions that exist in the market. So I wouldn't be selling. I'd just be holding gold, silver. Silver's going to rip too. It's going to rip, man. God, it's going to rip. Duke inventory, so that's drilled uncompleted well inventory, declined by 1,000 last year. Simply, we fracked 1,000 more wells than we drilled. This year, we will drill more wells than we fracked. U.S. oil production will decrease dramatically. So get ready for a dramatic decrease in supply. Dave Kranzler says something really ugly is happening behind the curtain. 2009 and 2020, a move like this would not have bothered me. And I've been trading gold futures since 2003. It feels different right now. It's relentless and supposedly a sanguine environment. Serious crap may hit the fan in the next few months. Possible. Maybe the Fed will step in and start printing some money. China loves silver. Just wait until 1 billion people try to buy just 1 ounce, which you can't. That's more than production per year. And that's where we're going to end it. So that's all I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Special coupon code. We've got a question and answer session going on right now, Saturday. It will be recorded. If you're viewing this later in the day, it'll be uploaded to the website. But we have a question and answer session at 7 a.m. Mountain Time. All right, guys. We'll catch you later. This is Finding Value.